PayPal stock has been crushed badly. It is down by 70+% since its peak, but is the current price low enough for it to be a good investment? In this video, I'll go through key market data regarding the payment market, and I'll discuss PayPal's latest business results and fundamentals. Stay tuned to see the most important information, and as always, all is said with educational purposes and is not meant to be taken as financial advice. Globally, when it comes to the payments segment, PayPal is the market leader with about a 32% market share. Second is Stripe with 20.5%. On third place is Stripe Connect with about 20%. And then comes Adyen with about 11.5% market share. According to data from Precedent Research, the payment processing market will grow by about 22% annually until 2030, going from about $113 billion to $572 billion by 2030. This is a major reason why big tech giants are introducing their payment solutions like Google Pay, Amazon Pay, and in China, we have Tenpay and Alipay, owned by Tencent and Alibaba, the two biggest tech companies. The main reason for PayPal's sudden 70% stock price fall is because their growth is slowing down and it is underperforming the growth of the sector by a big margin. In Q1 of 2022 compared to quarter number 1 of 2021, the company grew revenues by only 7%. In Q2 of 22, they grew by 9%, and now in Q3 the growth was 11%. This, coupled with an inflation rate of about 7 to 9% in the US, means the real growth of PayPal's revenue is stagnating. A company cannot be valued like a grower unless there is substantial growth. PayPal has lost this growth, at least for the time being. The next graph is showing the growth in active users from 2015 until 2022. The most recent growth was only 0.7%, and again, this is due to the increasing competition in the sector due to high potential growth and significant profit margins in the industry. For the full year of 2022, PayPal expects total revenues to grow by about 8.5%, and they expect about 8 to 10 million new active users to be added. A risk in Q4 for PayPal is a somewhat loss of users, as potentially some of the users could have been unhappy with PayPal's failed attempt to implement a new policy change in which if a user was promoting misinformation, PayPal could fine him with $2,500. The blowback was quite big, and after which the online payment service has since called an error. This happened in early October, so we could see if it has a negative effect on PayPal only by mid-January when the Q4 results come out. When it comes to debt management, PayPal is doing well. Their current assets total $55 billion, while current liabilities are $43.2 billion. This gives them a current ratio of 1.27, indicating good short-term liquidity. The total cash and cash equivalents of the company are $10.8 billion, while the long-term debt is $10.2 billion. So only with their most liquid assets, PayPal can cover all of their long-term debts. The equity of the company is $20 billion, but about $12 billion is in intangible assets, mostly goodwill. Goodwill is built up when PayPal has bought other companies and they have overpaid for them. This overpaid value is actually lost as the goodwill cannot be really sold off. But for accounting purposes, it is placed on the balance sheet, which is not correct, and it shows us a different picture of the actual balance sheet reality. As far as their balance sheet health, this is my only negative remark, that the intangibles are quite high in relation to the equity and total assets. PayPal is also operating quite efficiently with its capital, as the ROIC, or the return on invested capital, is about 17%, while the return on equity is 26.5%. Above a 12% return is good for both of these metrics. The current PE for PayPal, which stands for the price to earnings ratio, stands at over 40, though this most likely will fall during the upcoming year if the price stays the same, of course. According to expectations from analysts, the forward earnings per share for PayPal would be 0.97 in Q4, 0.76 in Q1 of 2023, for Q2 they expect 0.88, and for Q3 of 2023 they expect a 1. When we sum up these 4 quarters, we get a forward EPS for PayPal of 3.61. The current price per share for PayPal is about $86. To find the forward PE, we divide 86 by 3.61 and we get a 23.8, which is the multiple to PayPal's earnings. Even with the next year's expected earnings, PayPal is a bit too high for me in today's prices. If the stock falls to around $50, then I might be very interested in the company, as then the forward PE could be in the range of 13 to 14, which will give me as an investor an earnings yield of around 7%. Also, as an investor, I am worried that PayPal does not have a strong enough competitive advantage or a moat in more professional terms. This will lead most likely to a loss in market share and a downgrade in its future earnings power. If a company has a strong moat, I am willing to give a higher multiple to its earnings, as the price premium is worth it in relation to the lowered risk. As the risk increases, the price levels at which we are buying must get lower. Even from a falling business, an investor could have positive returns. It is all depending on the price. This marks the end of my analysis. Make sure to like the video, and if it was useful to you, subscribe for more stock analysis. Goodbye for now, and until next time.